Good morning. My name is Maurice Crespi. I'm the managing partner of Schindler's Attorneys. Schindler's Attorneys is co-founder of COBRA. We put COBRA together first week of lockdown. The idea behind COBRA is to partner up with businesses who can assist in any which way possible, assist businesses in distress, businesses in need, businesses who need advice from accounting to financial to legal advice. And we do so by way of Zooms. We have private Zoom sessions with you and your team. We do so through a knowledge base on our website, www.cobra.org.za. And we do so through these webinars. And these webinars, the idea behind the webinars is to provide insights to the public, to businesses, as to what experts believe the situation is. And today we'll be dealing with property, commercial property sector. We are going to be discussing where we are at the present, where we were, and importantly, the outlook. Where are we going? I think this is probably one of the biggest question marks when it comes to COBRA and really the rearrangement of society, the ruralization, for want of a better word, the move away from urban areas, and obviously the trend to work from home. That's all had an impact on property. And the big question is, will it ever go back to where it was? And who am I joined with today? I'm joined with Norman Raad, who's the CEO of Broll Auctions and Sales. He has over 20 years of experience in the commercial property sector. And Warren Castle, who's involved in business rescue, strategic planning, and operational turnaround projects. He holds a qualification in business rescue from the University of Pretoria, and he's a licensed business rescue practitioner with CIPC. Then we have Paul Duncan, who began his career in '96 as a commercial real estate broker with the Broll Group. Thereafter, he worked in London for 5 years at an investment bank before returning to South Africa to start on his MBA. He joined Catalyst Fund Managers in 2004, first as a real estate analyst, but ultimately managed the SA long-only funds, as well as being responsible for the Asian component of the global long funds. Catalyst Investments is a hedge fund, and it manages approximately 1 billion rands in assets. Paul's been managing the Catalyst Alternative Investment Hedge Fund since 2015. And then we have Theo de Bell. Theo joined Nedbank in '94. He's held both frontline credit and sales positions in the Nedbank business banking and the Nedbank corporate investment banking teams. He's currently employed as a structured lending team leader for Nedbank Private Wealth Central Region, servicing the regional offices in Johannesburg, Pretoria, Bloem, and he holds an honors degree in banking from the University of Pretoria. Before I move over to Norm, I'll be asking him just to give us a brief outline. Let me introduce the remaining panelists. We have Emma Marseille from IQ Business being one of the founding partners of COBRA, Renee Klopper, also from IQ Business, and that's it. I think I've got all the panels. So Norman, thanks so much for joining. Thanks to the panelists for being here today. Norman, where have we been? Where are we today? And where do you see us going?
Thank you, Maurice. Thanks for inviting me to this webinar. And it's good to be with such great people around me. I mean, the resume is there. I think we should hand it straight over to Paul and Theo to start talking. But yeah, thanks. Maurice, we've had the commercial property sector has had a trying time over the last year. I think even before COVID, we were facing challenges. The economy was struggling in a lot of sectors. And I think what's happened over the last period, COVID basically just fast forward what I think would have happened at the end of the day in a while anyway. I think where we were and where we are today, no one would have predicted, and no one could have told, understood the market where we are right now, but where we're going to go. So I have to give you a couple of examples of what we've seen over the last year, and I have to talk about values. A year ago, I think we're all guilty of this, is we overvalue. We'd like to believe our value in our assets are more than they actually are. And a year ago, we would on behalf of clients try and sell their assets. and we'd get to a certain price, and it was sometimes not good enough or not at their level. And those same assets have come to the market this year, and the prices that we're achieving are substantially less than they were last year. So it was a declining sector in values, and this COVID has basically exacerbated it. So right now, property, the tenants, good tenants in properties, good positions are golden. And I think that's the view that investors are making. And when I talk about investors, I talk about investors in the listed sector, owner-occupiers, and people that are directly invested in property. They're making certain decisions right now. And what are those decisions they need to be making? It's all, I think, around cash flow, around the tenants, and around the sustainability going forward. I think where we're going to be, I think it's going to take a while before everything stabilizes. I think you could see a lot more reversions in rentals, in income, a lot more difficult times ahead for the next possible 18 months before the economy starts stabilizing. And I think thereafter, we could see a slight increase or growth a little bit, but it's not going to be a short-term process. It's going to take a while. But again, you know, at the moment, one man's trash is another man's treasure. I think there's massive opportunity, and our title speaks to that, turning chaos into opportunity. We've seen a lot of opportunistic buyers come register on our auctions and try and participate. And I think that's a very, very good sign, even though that the values that they're prepared to pay are a lot less than they were a year ago. Yeah, so that's in summary, I think, where we've been and where we are, and a little bit of an idea which I believe where we're going to go to. I think in these times, massive amounts of opportunity present themselves, and I think the clever money is going to be investing in good quality assets with good quality tenants and covenants, and I'm excited for this period.
Yeah, no, interesting. Before I get to Theo and ask him to give us just a rundown on the financing landscape and what's actually taking place there, you made some comments. First of all, you said substantially less. What is substantially less? What are we looking at from a year ago?
Yeah, so, you know, I think, you know, they said there's different sectors. Obviously, Paul will talk about the listed sector. I'll talk about direct property and property values. So, you know, what is something worth? I mean, obviously, there's the financial calculation on a yield and a return that property gives you with regards to your tenant. But I think in this current environment, the restart button has been pushed, and the property values are almost at what is someone prepared to pay. And the values have most certainly decreased, and it's not across the board, because I think the logistics sector has held its own a little. I think the outlying rural areas, the retail have also held their own. And I think, you know, because there's a lot more demand in residential, the residential sector has also held its own. But the overall values have come up, because if you go to a bank and you ask for finance, they're not valuing it like they were a year ago. There's at least a 20% decrease or 30% decrease in some properties. And vacant properties have taken a proper hiding. And I must be honest with you, I mean, I don't think a property that is vacant for anyone, it could be a liability more than an investment. Your holding costs could be substantial, and it could take a long time before you actually find an occupier or a tenant that is suitable for the property. The commercial sector has been the most affected. And so when you say how much has it come off, I can't tell you that, but I can tell you, what I can tell you is some property values, it's the value is sitting in their books, it's a liability and not an investment. So, you know, across the board, I think everyone's looking for opportunistic buys, and people are talking about where it's going to be in the future. But I don't think there's going to be much growth. I know, I mean, almost certain there's definitely not going to be any growth in the income on properties for a while.
You mentioned stabilized in 18 months. I mean, do you see them ever getting to the levels? When I say, let's say, take offices in Sandton. I mean, at what point will they actually get to the levels they were in January this year, or several years ago at their peak.
So
you know, I mean, if people are going to work from home, at what point will those properties hold value again?
Yeah, so everything has cycles. I mean, the commercial space, you know, everyone's got also their own different opinion and view. You know, I do believe that people need to go to work. That's my view. I don't know if that's everyone's view. So the commercial space, I think, to a large effect, was already overpriced. The rentals were too high. But when you look at a new building and you have to go and do a new development, the spread between buying an existing property and redevelopment has never been so great. And I do think that there's going to be a space, there's going to be a stability, because I think the big corporates eventually will re-engineer themselves and probably create some sort of campus. And, you know, the WeWorks, I think, and the companies that are, what do you call it, where you share office spaces. I think they will come into their play now on the commercial side. So, you know, nothing's going to be like this forever. There will be eventually a turnaround. There'll be demand for commercial space, like it has been for years. But people are going to be adapting, and the properties that are becoming obsolete, should I say, or there's no use for them, there's going to be an alternative use for them. So conversion to residential, I think that's a massive play at the moment. And the young entrepreneurs who have that foresight and they have that ability to convert something into that is basically not useful to anyone into something far more creative and forward-thinking and progressive, will do very well in these difficult times.
Yeah, but I think what's key is there's going to be quite a bit of pivoting in the property space. Theo, just around financing, if you just give us an idea of the landscape.
Thanks, Maurice. I think it's important to say up front, you know, the fundamentals in financing a property has not changed. I mean, and there's no silver bullet, so to speak, you know, to solutions. And you must also bear in mind that each property, you know, is different. Each property has got different tenants, different owners, different loan to value type calculations, borrowing at different rates, you know, so each property really needs to be considered on its own. But having said that, the overall fundamentals, like I said, is really still the same. I mean, we first and foremost going to look at cash flows. I mean, if you're not buying a property because of cash flows, then you're probably in it for the wrong reason. And I think there's a bit of more focus at the moment on the quality. You know, in the past we were probably accepting that a tenant is going to pay to some degree, and you allow for a small percentage of vacancies and non-payment. But at the moment, there's a far more focus on the quality of the tenant. You know, how long has he been there? What industry is he in? What is the expectancy of him paying going forward? And I actually believe that a property with a solid tenant may well be worth more now than it was before COVID. You know, simply because there aren't many around. I mean, so yeah, the first consideration is always cash flow. I mean, what we typically do is, in the past we would have discounted cash flows around 20%, you know, to allow for vacancies and interest rate movements and, you know, unexpected expenses and that sort of thing. And when I say discount, I'm talking about net rentals. At the moment, we're looking closer to 30%, discounting it by 30%. And the reason being is, you know, interest rates are at a 50-year low. Norman spoke about cycles. You know, interest rates are also cyclical, you know, so at the moment, yeah, it's a great opportunity because rates are low, but, you know, property is a long-term investment, and you know, investors should know that rates will go up again. You know, by applying that 30% sort of haircut to the net rentals, we ensure that the cash flows are properly stress tested, and that you can withstand, even if interest rates go up by another 300 basis points, you'll still be okay. So that's the one thing. Cash flows is always the most important. Then I also just want to touch around, the value of the property, because people always tend to ask, the first question they ask is, what is the loan to value or the LTV that you will grant? I think it's, Norman also touched on it earlier, the value at the moment is what you can get in the open market. Whatever somebody is prepared to pay, that's the value. You can get valuations, formal valuations, that's higher than the purchase price, but we will always work on the lower of the two, and simply because that is the value, that is the real value that's achievable. Also bear in mind that valuations are generally based on potential rental income, whereas we work with actual rental income, so vacancies, like I mentioned earlier, is a big issue. Then I also touched briefly on it before, but when we finance now, we have a much sort of deeper dive into the tenants themselves. It's one thing assessing the owner of the property and the property itself, and that's a difficult part, because 9 out of 10 times you just see a lease agreement. You don't really know who's behind that lease agreement. So it's easy when you sit with big anchors. We all know who they are, but it's the smaller tenants that are the most difficult to assess. So that's why you got to look a bit broader and try and understand how long they've been around and what industry they sort of play in, and how COVID affected them, and whether they requested payment reliefs and that sort of thing. I think maybe as a closing comment, I think it's a fantastic time to be buying. There's a lot of things in favor for the buyer, but it is a difficult time to obtain finance. There's no doubt about it. Finance is also not cheap at the moment. People tend to forget that we were downgraded to junk in the end of March. So rates were impacted by COVID, which were more, I think, short to medium term, just caused by liquidity in the market. But the junk status, we're still in, and we'll still be in junk after COVID, So, generally, I think pricing is also a bit more expensive than before, but that to me is really how we try and look at things at the moment. There's not specific properties that we avoid. Obviously, if it's vacant, it doesn't have a cash flow, if somebody wants to borrow money from you, the first thing you ask is, how are you going to repay me? And if it's vacant, you can't repay. So it's really as simple as that. I hope that gives a bit of an insight as to how we look at things at the moment.
Yeah, thanks for that. Before I go to, I'm going to move to Paul around the challenges faced by the listed property sector. Let me ask you this. You'll recall about 15 years ago, I think it was, it was a bit scandalous, the banks redlining certain areas, not granting bonds in those areas. Do you foresee anything like that? Is it happening informally? Not necessarily in actual geographical areas, but also areas in the retail sector, the commercial sector. Is that happening?
Not that I've seen, Maurice. I mean, we obviously mindful of certain types of properties that are more difficult to finance at the moment. I mean, until recently, something like hospitality properties, that they're only opening now, so, and again, it comes back to the cash flows, the quality and the certainty. So if a property can produce cash flows and sustainable cash flows, it's got a value, and we will finance it. But again, as I said earlier, I wouldn't say that we're avoiding certain properties or areas. We are considering each sort of case on its own merits. It all falls back to the ability to generate cash flows.
Yeah, so actually the value is actually determined by the cash flows, which you also suggested. So it's all about cash flow.
Yeah, and I mean, even if you go and do the cash flow calculations, which is where we always start, and we will say, well, based on the cash flows, you can afford X against this property. And if you take that number, generally speaking, it falls into place with the loan to value that's out in the market, and that's a safe sort of deal for both the client and the bank, because nobody wants to sit. I mean, the banks don't want to sit with the properties either, with distressed properties. So it's in everybody's interest that we do a proper deal up front.
Paul, I'm going to move over to you, but before I do, just the audience, please ask questions. Questions are being posted. We'll get to them later. Post them in the Q&A, and the panelists, if you can open your Q&A, have a look at the questions. Some are directed specifically to yourselves, so you can prepare your answers. Paul, listed property, landscape.
Yeah, look, I mean, I think the bad news is that listed real estate environment, much like Main Street, is in a structurally very bad space currently. The reality is we got ourselves into that position as a sector, not as a result of COVID. The writing was on the wall many years ago. The best way to explain the situation we're in is to use an analogy in that, many of you may know the story of Joseph, who became the trusted advisor for the Pharaoh, and he used to interpret his dreams. And the Pharaoh once went to him and said he had a dream with these 7 fat cows and 7 thin cows, and asked Joseph to interpret it. And in South Africa, 10 years ago, we were in a situation where we had 7 fat cows in front of us. And what those 7 fat cows implied was that we had good years looking forward. And instead of utilizing that positive momentum, we started to distribute to investors more than what we were actually generating in any one year. And it didn't provide for the weaker years. And then when the writing on the wall started coming on in South Africa, and that the fundamentals were looking particularly bad, instead of distributing what was available, the institutional listed sector started moving up the risk curve and started looking for growth elsewhere to offset the weaker growth in South Africa. And what they did was they went overseas and they used the positive carry or positive spread between high yielding properties offshore and the cheap cost of debt, and used that boost to enhance their income back in South Africa, hoping that over time they'd be able to outgrow this excess leverage that they had taken. So effectively what they were doing was they were boosting weak South African earnings with aggressive offshore earnings. The fundamentals in South Africa have been bad for a long time. If you look at where the property market implies the valuations in direct real estate are, just going back to the comments or the questions you asked Norman and Theo, the market is implying right now that asset values or transactional values are 20 to 30% lower than the book values. And Theo's comment is accurate. The book values are just one other person's interpretation of value. Doesn't make it right, doesn't make it realistic. The market, the institutional market, is just another bunch of investors think they are wrong by 30%. So, I mean, right now the situation, we were bad coming into the current environment because of weak fundamentals and aggressive behavior pushed on management teams by investors. There's no denying that as well, because investors wanted high distributions and management moved up the risk curve to achieve this, got themselves into some significant difficulty, and then COVID's come along and accelerated the current situation quite dramatically. Where are we now? I mean, the reality is the last couple of months have been dramatic for the property companies. It's all been about cash collection and just sort of maintaining their interest cover ratios. Most of these companies have a break even of like sort of 60% collection rates, because they obviously pay away operating costs, which they've got no flexibility on, and they pay away interest on debt before they distribute their net cash to shareholders. And they were battling to meet those sort of break even levels, but things have definitely improved. However, going forward, the reality is that earnings are going to be a lot lower than pre-COVID levels. They were deteriorating anyway. We've taken a proper hit now again, and I think they will continue to come under significant pressure. That will lead to further write-downs in book values. They are unrealistically high. So, I don't think investors should get fixated on net asset value, because net asset value is, again, just a reflection of the independent valuer's valuation, which we believe is artificially high. So net asset values will decline, earnings are declining. The reality is the market is reflecting that in its pricing. So that's the kind of good news, is that the market is looking forward and capturing that in the pricing. So there is deep value in the listed real estate sector in certain companies. I mean, there is some proper toxic balance sheet risk on many of these businesses, and they do need to de-gear. And again, going back to Norman's comment, our kind of advice, if you want to call it that, to many of the management teams, is that selling today at a 10% discount is equivalent to selling at a premium to next year's book value, because these asset values are going down. And we're trying to get that message across, because the only way you can improve your LTV, your future ICR, is, amongst other things, is to sell assets. Obviously, you can stop paying dividends, and that's one option that they're looking at. You can raise capital, but to raise capital at these discounted levels would be the last option really available. So selling assets is the most obvious way to be realistic about pricing. So the future of REITs is all about repositioning and fixing the balance sheet. There's no doubt about that, and that's the focus. And the other issue is obviously around more sustainable payouts. Property companies in South Africa, or listed REITs in South Africa, the way they're structured, it's a straight flow through. They collect rent, they pay costs, they pay interest on debt, and the balance is distributed 100% without any tax consequences to shareholders. That model is not sustainable. You need to retain some cash to maintain your properties, for one. You can't keep taking off the balance sheet, taking from NAV to maintain your buildings and distributing it out as income. So there is a component that needs to be maintained. So I think distribution payout ratios will be reduced significantly going forward, and balance sheets need to be cured. And if you're going to panic first. The guys need to wake up to the reality and sell aggressively if they can, because I don't think things are going to improve in 12, 18 months. I think we're looking at a tough environment with valuations declining significantly over the next 12 to 24 months. As I said, from a listed perspective, I believe it's reflected in the price, but with more risk to the asset class is probably what we would have communicated, say, 3-4 years ago, because of both structural issues on the property companies in terms of the offshore leverage, and as a result, unfortunately, of the circumstances that has accelerated the already weak fundamentals due to the COVID pandemic.
And everything's cyclical. We've heard that. The recovery cycle, in your view?
Look, I think from a institutional appetite for the asset class, the REIT market for institutional investors right now, we perceived as mass murderers, like who need to spend 20 years in jail before we rehabilitated. The institutional investment community is not interested in the asset class. They are, if they're looking for financials exposure, they'll rather buy the retailers or the banks. They've seen what's happening with property companies. They've seen some of the behavior. They've seen the issues around the payout ratios, and they're just not interested. No matter how we try to explain, in many instances, there is value. There is substantially more risk, but there is value for an investor who understands that risk and looking through the cycle. So there is value. But I don't see appetite and momentum coming back to the listed real estate sector, which is ultimately what you need for share prices to rise. You need the institutions in mass and the asset allocators in mass to start being comfortable with the asset class again. I don't see that happening until we've rolled through 1 or 2 reporting periods, and the property companies are in a position whereby they're confident enough, because their balance sheets are restructured to an acceptable loan to value and ICR level, where they can give guidance around paying a sustainable dividend again. And it's until that point, which I don't think is probably, I would estimate that's not going to happen over this reporting cycle. They're still not providing guidance. Some of them are still trying to defer dividends. I think we're 12 to 24 months out. And once they're in the position to do that, I think you'll start seeing institutions coming back and supporting it, because they're very anchored on the distribution as their reference point for investing in the asset class. And that's where I think you'll start seeing allocations back to the sector. And naturally, that will pull the market back up. Even though the value is there, I think that's when you'll start seeing the momentum drag the sector back into favor again.
Valuable insights. Thanks for that. I'm going to jump into a question directed at Norman. Before getting to Warren, Warren's our BRP is going to be telling us what he's seeing on the ground in relation to distressed properties, distressed businesses. But before we do that, Norman, what is your view on the super regional mall's future? Thanks, Jedrick.
My view on the super regional malls. I think that's also a question for Paul. But from like on the ground, I think the super regional malls. I think there's been a lot of a lot of struggling tenants, a lot of struggling retailers. So the values of those shopping centres have come down tremendously. I think the average rental rate, the occupancy or the tenants within those shopping centres, and that's a downward pressure. I think the future of them, I mean, I hear that Amazon and the likes are looking to take up space in some of these super regional shopping centres. I just think, it's a matter of time when everyone will start going back to...
Your mic, your mic's pretty bad. Try again.
I just think over time, the people will start going and experiencing going back to the shopping centres, and it's going to take a little while. But I think for the tenants, I think there's been a lot of downward pressure. People are downsizing. The rentals have been very high, grossly over high for some of the smaller line shops. And we've seen that with the closing down of some of those retailers. But over time, I think everyone wants to enjoy the experience of going to these shopping centres. And I think what's also had an effect is this COVID with the restaurants and bringing people to the feet to the shopping centres. There's been no positive out of this COVID. There's been no positive out of the economy and about the retail sector. So, there's been a lot of downward pressure, and I do believe that it's going to take a while before they start correcting, stabilizing, and there's any growth seen there. But, they are good assets, but try and sell one of those assets in these difficult times. I don't think there are any buyers for them, and I don't think you can really quantify the exact value right now, because I think through this COVID, the real valuation and the amount that people can pay, can afford, and will survive this period is still to be seen.
Yeah, thanks for that. I'll be dealing with Panika's question directed at Theo shortly, but Warren is a business rescue practitioner. He's the man on the ground. He is negotiating with landlords and tenants. He is part of COBRA. This is what COBRA does. We have mediation services, and we do it on a gifted or shared value basis. So bear that in mind. If you need any assistance, COBRA is there for you. Warren?
Thanks, Maurice. Because there are questions, and I think the value of this whole process is a lot of the interaction. We're going to keep it quite short. And I'm not going to say what everyone wants to hear. Unfortunately, from a on-the-ground point of view, what we're seeing is me. Okay? And without being sort of facetious or rude towards that, what's not happening is often sitting in a meeting and people show me these amazing cash flow forecasts. We're going to get this, then we're going to get this, we're going to get this, we're going to get this. Unfortunately, this comes from the bottom. And the problem we're facing right now is the tenant, the guy who lays that golden egg, is in serious difficulty. And what we're not seeing from landlords is preemptive action. Landlords aren't coming down to the tenant saying, well, how distressed are you? When COVID came, landlords said, we'll give you a rental reduction, but we'll claw it back. We don't want to affect our business. And what we're starting to see from landlords is a little bit of the realization that these small guys and these medium guys falling over start affecting your business. That lease, although it's signed for 10 years, is only worth what you got paid last month. Okay? It's a month to month. You literally are on month to month. And a lot of landlords are not cognitive of the financial distress their tenants are facing. And there's always been an attitude with landlords in the past, well, if you go, someone else will come and I'll get more rental. And we are seeing a shift from that, from a ground roots point of view. But sort of the message going forward is you actually need to go back and look at every single tenant you got and say, Mr. Tenant, how are you doing? And how can we walk this road together to get to the end? Because replacing tenants is not easy. Retaining tenants is not easy. And rent is now a significant cost and a significant fixed cost in a business, and that is part of the distress, is the guys are paying rentals that are no longer sustainable. And there needs to be a shared model, a model going forward of a base rental, because everyone's got costs, and some form of turnover rental. But fundamentally, the value of a property is the value of its income. And from a business rescue point of view, what we're really saying to landlords and investors, we need to start looking after the chicken, okay? Because otherwise there's not going to be anything there to lay that egg. And that's what you're taking to the bank. That's what you're taking to Theo. That's what you're putting on the market. That's the value of the business, is that income stream. And there needs to be a fundamental shift. And from a business rescue point of view, we're really trying to engage with landlords as partners. You know, we all need each other. And I think that's part of the mind shift. So, you know, to Paul's point, the good that's got to come out of COBRA is we've got to start seeing ourselves as partners. Not, I want to get as much as I can out of this, you want to get as much as you can out of this, and we squeeze each other. We've got to find that win-win situation through mediation, through working together, through showing our books, through sharing. But there's got to be a fundamental shift in the relationship with landlord and tenant. And unless that happens, we are going to get more and more vacant space that is not going to be filled. And eventually you've got a shopping center that literally has too much empty space, and now we have issues. So I'm going to hand it back to Maurice and the panelists, but from a very short point of view, there needs to be a rethink. And, you know, we use this African word Ubuntu. There needs to be a shift in Ubuntu. Thanks, Maurice.
Yeah, I agree wholeheartedly. And what we're seeing on the ground as Schindler's attorneys is we're actually seeing many landlords are in fact being reasonable, and what's being negotiated by the COBRA mediators is basically variable rents throughout, and with the ramping up 2 years down the line, and the ramping up is tied into the previous year's performance. Theo, there's a question by Panico. I'll read it out for the benefit of our audience on Facebook. When you look at underlying income streams, cash flows, how do you view head leases 12 to 24 months from sellers?
How do we view, sorry, just repeat that. How do you view head leases?
Head leases, yeah, from sellers. Yeah, what do you look at the underlying income streams? When you look at the underlying income streams and cash flows, how do you view the head leases? So basically, what is your, what is the focus?
Yeah, again, I mean, any, Maurice, any lease, whether it's a head lease or call it the end user, I mean, it's like we just heard from Warren, you know, it's a month-to-month basis, you know, so you got to view it in light of the ability of that party to pay, you know, and so we generally, we do not have a problem with head leases. You know, there's certain industries where head lease is preferable, but generally speaking, a head lease is as good as the person that signed it, you know, and that goes for any other lease. There was a question around areas where we see types of properties. Maurice, just one of the questions that I saw, and I don't know why I'm getting all the difficult questions. They should go to Norman. You know, again, I don't know whether there's per se good or bad areas. You know, I think what was good before COVID is still good, or should still be good now in terms of areas. You know, like Norman said earlier that COVID didn't change things, and I heard it from somebody else as well. COVID just sped up things that were already happening in the market. You know, this hot desking and work from home is not a new thing. I mean, companies were going there long before COVID. COVID just sped it up. You know, so yeah, I mean, at the moment, I would think twice before I buy offices in Sandton. You know, I think the last number I saw, there was 1 million square meters vacant in Sandton. You know, that's a big number. I think it's a couple of rugby fields. So, so obviously you don't want to go there. But again, if you've got a good tenant that you think is going to be around, it shouldn't stop you from buying that property. But just be aware like you heard from Warren now, there are alternatives. So, you are going to see pressure from your tenant in terms of regression in their leases, so, and you're going to find it difficult as a landlord to say no, because you're not going to replace them in the short run. But properties that seems to be attractive at the moment, I mean, warehousing, I read something interesting around online shopping and that, moving out of big shopping centers, there's a bigger demand for warehousing. Self-storage. People need more space at their houses, so they tend to look for self-storage facilities. Regional shopping centers, or neighborhood shopping centers, I should rather say, seems to be doing well. I mean, they're reporting feet count sort of at levels back, and in some cases even above where it was, pre-COVID. Rural shopping centers seems to be doing quite well. They offer very attractive yields. It brings its own problems in managing it, but so it's difficult to answer the question, because again, each property should be considered on its own merits. But ultimately, it boils down to, like Warren said, are you going to get paid at the end of the month? And if the answer is yes, and it's going to stay like that for a while, well, then it's a good property.
I'd imagine, there's a lot of talk about the ruralization, a lot of people moving away from the city centres. We're seeing it in the UK, in America, and in fact, we're seeing it in South Africa. And I think that would have a direct impact on, let's say, the rural shopping centres, because there'll be a greater demand with people moving. You take the coastal towns, Plettenberg Bay. Plettenberg Bay used to see numbers only during the holiday season. Now they're going to see increased numbers throughout the year. So those properties, I get it. I mean, those properties are probably going to do very, very well. There's a question for Norman. Before I get to the question for Norman by Timothy, I'm going to read out what there's a comment by Trevor that he's posted on the Q&A, and I'm reading it for the benefit of the Facebook audience. I think Norman is spot on. Lower interest rates have mitigated the impact to an extent. Difficult to give an exact decline in value. At the end of the day, it's about yield, and yields have not really changed. The decline in value mainly has to do with the reversion of rentals to the market. And I think that's basically, I think there's consensus on that. Thank you for that, Trevor. The question, Norman, from Timothy: how does the total value of properties sold at your last auction compare to the same auction last year?
So, I mean, obviously, I think there's been a lot of opportunistic buyers now, and I'm telling you that that is the fact. We've had a lot more registrations at our auctions this year. I think people are seeing this time, or would we say this chaotic time, as an opportunistic time. But the prices haven't been there, which the sellers would like. But there are a lot more reasonable, or should I say forced sellers, or not, maybe that's the incorrect word, a lot more flexible sellers in their price that they're trying to achieve. And there's been a lot of trading. So last year, I will say to you, we had a very difficult year on the auction platform, because the sellers, there wasn't COVID, and the sellers were unrealistic. They thought they were sitting on something worth far more valuable than they actually were. Right now, there's been a reality check, and the buyers are paying less than last year, but there are a lot more sellers accepting the prices this year than we had last year. So the confirmation rate has surprisingly increased, but the values have considerably decreased. There's still a lot of people willing to invest in bricks and mortar. There is still value. It may be 30% or 20% or 30% less than they were last year, or sometimes in some cases 50%. But people still trust the property sector. They still trust bricks and mortar. And I think Theo mentioned it. The tenant, the cash flow is absolutely key, and that's what people are looking out for. So, we've had a very good and well-received auction, the last couple of auctions, and I think it's going to continue to be that way. There's going to be, I will repeat, there's going to be a lot lot more stock coming to the market. There's going to be a lot more stock, and there are properties that are finding their way to the market that would never historically be for sale. They were being held onto at all costs. That's not the case. People are starting to realize their assets because they need to set off some debt and invest back into their businesses for other reasons. But there's going to be a lot more stock in the next 24 months that are coming to the market, and there can only be so many buyers. Just to touch back on the last, I was thinking about the super regional malls. I do think South Africa have had too many malls. We've got too many malls, if you look at it. And, I've seen these valuations coming down and down and down. There's just too many super regional malls. And I don't think I mentioned that the last time I spoke. And I think there's going to be a little bit further pressure for some of the malls that are in not the strategically best positions.
What are your views on this ruralization? The comment that the coastal property is an example. The coastal commercial properties may indeed do better.
So I completely agree with that. We've seen a lot of people actually almost semigrate down to George and to the Eastern Cape over this period and not come back. And some of those retail properties have done well. And I think some of the people are not going to come back. We've sold a lot of properties, and there's been a lot of demand in outlying areas. So there's still that demand there. And I think the hardest hit by the overvaluation of properties has been in the metropolitans, But it's also saying that too broadly speaking, because it's also, some of the nodes are different to others. I mean, like Cape Town's an anomaly, and certain areas of Durban is an anomaly. But I do agree with what you said, and most definitely yes, and especially even in the residential sector. We've seen, a lot of sales happening in those areas for different reasons. Some people trying to sell their second house, but other people trying to relocate there.
Yeah, Ismail asks, where is the smart money going? I think that you've answered it.
The smart going, yeah, I think I've touched on that, and I think there's guys are putting their money into cash flow and into these outlying retails, into logistics, as Theo said. And just remember one thing that we're still way behind in is that we do not have enough housing for our South African economy or for the South African people. So there's always going to be this demand for housing. And yes, people will get their jobs back and they will be in business again. So there is a little bit of pressure on the residential market, but there's a massive demand for residential homes. And I think that sector is going to start ticking up again in the near foreseeable future.
I see there's a question for Paul. Paul, what trends or behaviors are you seeing from the listed funds? How are they weathering the storm, and what is the general consensus to defend their share price positions? Hold, repurpose, or sell?
I think it's sell, hey? The reality is like I said, there are three options for the listed companies in the current environment. Obviously, they're focused entirely on from an operating perspective, collecting their rents and maintaining occupancies and things. But the reality is they've got to, there are three sources of capital. That listed property companies don't sit on excess cash because they distribute. That's how the see-through REIT structure works. As I said before, you collect rent, you pay cost, you pay interest, and 100% flow through. So the reality is they need to fix their balance sheets. They need to prove their ICRs because market rents and the top line is declining and your cost base is increasing. Utility and administered costs are increasing and your revenue line is declining. A lot of the property companies hedge a lot of their debts. They aren't getting massive benefits from the short-term rate cuts, so their ICRs are coming under pressure. The banks can stomach LTVs, but they don't like it when you can't service your debt. So if those ICRs come under pressure, the only way you can deal with it is by selling assets, raising capital, or retaining dividends. So that's the focus. The primary one to try and do is sell what they can. And as Norman says, there's more coming to the market. My comment is, if you're going to, like I said before, you're going to panic. You want to panic first. Don't wait. Don't be too clever. The amount of value that needs to be moved off these balance sheets to bring LTVs and ICRs back to the level where these companies are on the front foot is massive. We can talk about percentages, but when you look at the absolute numbers, they're tens to hundreds of billions of rands worth of activity that needs to occur, and there's just not enough liquidity and depth in the market to absorb that. So that's my concern. As I said, I think it's in the price, but you still have to act on that reality. So I think the trends we're seeing is that it's all about cash preservation. So, selling assets where they can, and they need to be more aggressive on that. And then to obviously restore their balance sheets so they can start paying dividends the other way. In the short term, unfortunately, means they may have to retain some cash, because it's far easier to retain cash, pay some tax on it, than raise capital at these deflated NAV type levels or very low earnings yields levels. So that's the trends. Right now, it's about capital preservation, balance sheet management, and just collecting and maintaining occupancies as best they can. But repurposing, I think there are kind of opportunities for that, but that's not really, I think, high on the agenda right now. It's tapping liquidity wherever they can.
Oh, sure. Theo, there's a great question by Greg. What's happening with the bank covenants? I'll read the full question out, but he says, should market values adjust significantly down, what impact would this have on bank covenants? With obvious reference to LTVs, do you believe banks are adequately covered by the security property they're holding in the event that the loans are called? Where are you with these loans being called, and what's the bank's attitude? Are they triggering the covenants?
I see I'm again getting the difficult questions, but that's okay. So first of all, I mean, Norman said earlier that we haven't seen the properties, these distressed properties in the market yet, and I think he's right, because the banks have been giving payment moratoriums, and most of those, from what I've seen, they sort of came to an end in June, July, August, and they generally, clients are asked to start paying again sort of August, September. So I don't think you necessarily have seen the distressed properties in Warren and Norman space yet, purely because they still had payment reprieves from the banks. So that's the one thing. As far as the LTVs are concerned, property is a long-term investment, and if you're dealing with the right client, you got to go with that cycle that Norman also mentioned earlier. So when the deal was done up front at a certain LTV, it is what it is. That it was acceptable then. Yes, the property you probably now sit with a higher LTV. But again, if the loan is being serviced, does the bank really have to worry about that regression in the LTV? I suppose on paper you have to, but the first priority will always be, is it being serviced? And it brings us back to the cash flow discussion. So it's a tricky one. Also, how do you value it? I see there's also a question between book value and market value, the difference between those two. Now, it's quite simple. I'm not an auditor, but generally they value properties on the assumption that they're fully occupied, and they allow for a small percentage of vacancies, which is normally or very seldom higher than 5%. So if you assume you're fully occupied and you've got 5% vacancies, it gives you X in value. Whereas market value, I think, takes into consideration the real cash flows, the real vacancies. And that's where the disparity is at the moment, so because the real vacancy may be 20% as opposed to 5% in the theoretical calculation. So and the only time that you're really going to determine the value of a property is when you try to sell it. Up until then, it's all estimations.
So Emma makes a comment. I'm going to keep you in the hot seat because Wilfred's asked a question that I think ought to be directed at you. Emma makes a comment from a housing perspective. I've definitely noticed several office blocks in my area being converted into apartments, and that leads me to the question. Morning, everybody. This is from Wilfred. Thank you, Wilfred. From a financing perspective, if you do conversions, i.e. commercial to residential, initially there'd be no cash flow. So how do a financier assess such a project? And there's the assessment, and I'm also going to jump in there. What's happening with post-commencement finance? If you can business rescue and post-commencement finance, when it comes to looking at rescuing businesses by pivoting from commercial to residential.
Yeah, so Maurice, if I can go first before you jump to Warren. if you're going to be repurposing your say office space into residential, I mean the best place to go is to the bank that you currently owe money to, because that bank is going to be the most interested in assisting you. And it's really just around managing the project. I mean, you can have interest roll-ups during the period, or you can have an interest only sort of scenario where you only have to service interest whilst you're doing it, and it's really going to again be based on what realistically could be achieved from a cash flow point of view once you're finished. You know, so are you going to hold it? Are you going to sell it? You know, if you plan to sell it, do you have pre-sales? You know, so it's not something that happens overnight. I mean, I hear everybody talking about converting to residential, and that's probably the best sort of purpose for those properties at the moment. But it's expensive and it takes time, you know, and you got to get zoning right. These things don't happen overnight. You know, so I think Paul is right when he says that people are going to try and sell first before they convert, because I think realistically, if you want to convert offices to apartments now, you're probably looking at a two-year window, you know, and by then the market may have moved again. So who knows? It's a very, very difficult problem to address.
But you touched on something which is very, very interesting, and it's something that COBRA, I think, should take on, and that is if the regulatory environment is such that it's going to take time, for instance, to change from commercial to residential, well, that's going to have an impact on the property market. So there is something that can be done. Warren, on the question of post-commencement finance, the finance partners that we have in COBRA, what is happening? What's the attitude when it comes to post-commencement finance, pivoting, and the financiers?
So Maurice, thank you very much. I'm going to go back to Theo's sort of question and then come to yours. One of the issues, and we're actually dealing with it, of repurposing a building from commercial to residential is engineering and structural, okay? And it's a massive job of lightweight walling and structural engineering. So we all look at this and say, it's an office today, tomorrow morning we're going to turn it into a residence. It's very, very difficult and very, very expensive. And we're seeing guys in that space, bizarrely, in distress because their costs and their margins just aren't enough. And that is a general issue with the building industry. In terms of the PCF funding, really, at the moment, it's quite a difficult space. And what we're finding is where we are going into companies, most of these assets are encumbered. So property is the quickest and best way to raise PCF funding. So where we've got an unencumbered building, we want to talk to people about selling it, buying it back, using it as a funding mechanism. But we often find that people's security, and that's where the COBRA environment needs to come in to mediate, is very stretched. So someone who has a debt, a security on one asset will have a security on another asset and another asset. And it starts becoming very difficult to sell one asset to raise funding without stepping on someone else's security. And hence why there's need for this mediation and this working together. So there's definitely an opportunity to use PCF funding, but it is a mediation that needs to take place because I don't want to let go of my security so that you can raise money for something else.
Thanks so much. I'm going to end off with a comment by Deirdre. It's quite interesting, and it's an interesting thought. It's for the panel. With e-commerce, online shopping growing rapidly in South Africa, my view is mixed-use developments are the future. Work, live, play, and store, creating convenience for living, working, shopping, and creating storage space, all on one site. In America, some large malls are being converted into residential units of a small retail area due to online shopping. My view is large super-regional malls will have to adapt and change some of the large vacant space into distribution centers if allowable. Well, let me say this, I hadn't thought of that, and I think it's an interesting, very, very interesting concept. I'll ask just to conclude, Norman, do you want to comment on that? You're on mute.
The retail sector, everything needs to be flexible, re-engineered, and there's going to be massive changes to the property sector. The landscape's going to change. The way we experience shopping centers are going to change. So, yeah, at the end of the day, I agree with everything that he's saying there, and we maybe a few years behind, but we'll eventually get there. But I still believe that people like the experience. And they will still go and enjoy that. You know, people don't want to just buy everything and stay at home and do everything online. I think there's that experience part of it that will always, we are human beings. We like to interact, we like to engage, and we like to see each other. And that will always be around, I think, in this day and age.
And a concluding comment to all you guys from Trevor. Guys, thanks so much. It has been most informative. Well done to all the panelists. Well done, guys. Perhaps we're going to have more of these webinars going forward. And I certainly will make sure that I bring you guys back. This is one of the most well-attended webinars on COBRA. So it is a hot topic. So we ought to have these at least once a month, guys. So thanks so much to the panelists. Thanks so much to the audience. Please join us again. Go to our website, www.cobra.org.za, to check out the upcoming webinars next week. Or drop us a mail if you need any assistance, and we'll gladly reach out. Thanks again, panelists. Thanks again, audience.
Thanks, Maurice.
Bye, everyone. Thank you.
Bye.